All right, what is going on, tycoons? What's up, traders? Super excited for today's video. We're actually going to go over another dividend stock. We're going to take a look at SWK. This is Stanley Black & Decker. Now, many people always look back in the past with hindsight and tell you, hey, you should have been buying the dip during this bear market crash. And people love to show you that stuff. But a lot of people aren't doing that. So while I'm personally looking for some dividend stocks to possibly add to my dividend portfolio, I'm going to be updating that with you guys. Now, I don't have any current positions in SWK, but it is looking like a good opportunity possibly to me. So remember, it's up to you to do your own due diligence and research if this is something that you would want to add to your dividend portfolio. Of course, none of this video is financial advice, but I am actually going to give you guys a very good breakdown and technical analysis of some of the key levels and possible scenarios to watch out for on SWK. So make sure to smash that like button, subscribe to the channel if you guys are new, and we can see here that their annual dividend is about $3.20 per every share. It's got a current PE ratio of about 12.85 and a dividend yield of about 3.92%. So this is why it's got my interest, okay? The PE ratio isn't too bad right now. It's got a decent dividend yield. And in my opinion, this is a company that is going to stay around, right? Now, unless robots just start doing all the drills and doing all the works for us and start making their own drills, all right? But I think that drills, saws, a lot of this home improvement and home builder stuff is really here to stay for the long run. And that's just my opinion, but I do think that it's not something trendy, right? Selling drills, selling saws, selling screwdrivers, hammers, things like that. That's not necessarily just a trend. That's something that people have been using for a very, very long time, and that most likely will continue in the future. So what we're going to do is we're actually going to start off on the weekly time frame here, okay? And so this green box right here, this is our weekly chart demand zone, and this is from the pandemic lows. So this is the COVID crash. So take a look how we actually retested it about 4 or 5 times here recently, guys. So I mean, when you're talking about, good opportunities, a lot of people were saying, oh, you should have bought the dip during the COVID crash, right? We're actually back at pandemic lows or recently reached pandemic lows, and we are starting to get a little bit higher. Now, there's a couple chart patterns on here. We have a head and shoulders and an inverse head and shoulders pattern. Now, if you're not familiar with those, I'll give you a quick breakdown. So a head and shoulders is actually a bearish chart pattern. And so it's identified by a left shoulder over here. Then you get another peak, and then you get a right shoulder over here. And once you break this trend line right here, all right, this is known as your neckline. You would expect the head and shoulders pattern to reach the target of where the pattern began. And as you can see, that definitely happened. Now, what's really interesting is we currently have an inverse head and shoulders forming, okay? And this is going to be the exact opposite of the head and shoulders. It's actually a bullish pattern, all right? So we've got a left shoulder forming here. We've got a nice little head right here, and we're starting to put in a right shoulder right here. Now this, all right, we have to question if it's going to play out. This is not a guarantee, okay? We're starting to form a right shoulder, but similar to how we were over here, when we originally started forming this right shoulder on the head and shoulders, if this thing would have just kept going up, it would have invalidated the pattern, okay? And that pattern would not have been a head and shoulders anymore. So if this thing starts to drop, okay, and retest our previous demand zone or even drop through there, this pattern will be invalidated. But it's important to start tracking some of these patterns as they're developing, so that way you can catch the move if they end up getting confirmation and playing out. Now, something else really interesting, okay, if you take a look, this right here is the RSI. This is your relative strength index. And what this does is this goes and gives you the relative strength of a stock at its given price. And so what we can see is we actually have a little bit of a divergence here. If you're not familiar with that term, I'll go ahead and explain that as well very quickly. So take a look how we have a low, all right? We have a low on our RSI, and we have a low on the stock price. What do? We actually come down lower and test that previous demand zone. So clearly the stock is in a downtrend, right? It's making what's known as lower lows. Okay, we have a low and then a lower low right here. But if you take a look, the relative strength index is diverging from that. At this point where we have a lower low on the stock price, we're actually making a higher low on the relative strength index. So what we've done is we've actually increased in relative strength as the stock price has decreased. This right here is a term known as bullish divergence, and it's an indicator that traders use to spot potential bullish activity. Now, as you can see, it's had a nice little pop since then. Okay, here's the bullish divergence right here. And then you see it's actually gone up a decent amount. Okay, we went from about 70 all the way up to over $90. So that's a $20 move off the share price if you were able to trade that bullish divergence. Okay, now we're going to move on here, and we're actually going to go to the daily chart and zoom in a little bit to a smaller time frame, the daily chart. Now, as you can see, right, there's obviously some big blue boxes on here. Now, what are these? Well, these are gaps on the daily chart. Okay, if you're not familiar with gaps, these fill about 90% of the time historically. The big question is when they're going to fill, not if they're going to fill. So during this bear market crash, there's actually been a lot of gaps down on many stocks in the stock market. And, you know, those gaps are filling, right? And some of those gaps are a year old. Some of those gaps are 5 years old. And it's taken a long time, but this bear market has actually been healthy in a pullback and filling a lot of those gaps down. Now, the reason that I'm pointing out the gaps up we have to fill is because we're currently at about $87 a share, right? We have a gap up to $114, okay, and a gap up to fill to $137. When I say gap, what I mean is there's a gap from this candlestick to the next candlestick, okay? Notice this big long space. I actually love to chart these up and make these into a nice blue box so that way I can see it very clearly and stay alert, right? My favorite thing to do is set some alerts at these regions at the top or the bottom of gaps, so that way I can be alert whenever a gap is potentially about to fill. Now, with that being said, you know, if this gap fills up to $114, that's going to be almost $30 per share you're going to get in return. Now, if you invest at $87, that's a pretty significant return on your investment. If you can capitalize $30 extra off of the $87, that's roughly around a 30% gain doing some quick math. And over here, 137 is going to be an even greater gain. Now, the big risk, okay, is that you don't know when these gaps are going to fill. So if the bear market is going to continue, price can most definitely head lower and continue to head lower and keep heading lower. And, you know, there is that 10% chance that these gaps may never fill. So you'll definitely have to keep that in mind. It's just something that, like I said, I like to set some alerts on, okay, and pay attention to. Now, if we pay attention here as well, we talked about bullish divergence in the last chart. In this one, we actually have a slight bearish divergence. So take a look how we have a high here and a lower high here. But on the stock chart, we actually have a high and a higher high. So in this case, the price of the stock is actually in an uptrend here, but the relative strength index is actually losing relative strength. So this would be a term known as bearish divergence, and it's an indicator you could see some type of bearish activity. Now, sure enough, we did end up getting a pullback after that bearish divergence, and we're actually setting up a head and shoulders. Remember, the head and shoulders was the bearish version, okay, on the daily time frame. But as I mentioned with that weekly chart, it's just something that's forming right now. It's not confirmed and it hasn't been validated, but I have to keep an open perspective to some of the bullish scenarios and the bearish scenarios, so that way I can be prepared and not be caught unexpected, or rather be caught, you know, not knowing what happened by some type of unexpected move I wasn't prepared for. So, you know, on the higher time frames, we are looking good. We're setting up for a possible inverse head and shoulders, the bullish pattern. Okay, but on a smaller time frame, we do have this head and shoulders here we need to be cautious of. So what we're going to do is we're going to pay attention to see if we break this neckline here, that could be confirmation that we're going to come back down into this demand zone and retest the $70 to $75 area. Okay, but if we continue to rally, we have a good chance of invalidating the head and shoulders pattern. What we also need to pay attention to is our RSI. Because of that initial bearish divergence trend line, if the RSI comes back up to these levels, there is a chance it could get rejected back there at that bearish divergence trend line. If you're bullish on this, what you're going to want to see is a breakout and then a retest of this trend line and be able to claim that as support from prior resistance multiple times that it's been resistance. If we go to the next chart, Okay, what we're going to do is there's these series of 3 yellow lines that we have on the chart. Okay, and these are actually known as the Fibonacci levels. All right, now there's 3 most common and most well-respected levels, so that's the ones that I'm covering in this video. Those are the 61.8, 50%, and 38.2% retracement levels, and you use these because price action doesn't go in a straight line, right? Nothing moves in a straight line down or in a straight line up. Rather, you get a move up retracement, continuation of the trend, or you get a move down retracement, continuation of the trend. So, during this bear market cycle, we can see that that's exactly what we were doing, right? We're moving down. We're doing a healthy retracement up near our 61.8% level. And then we continue that trend and put in a low and a lower low. Then we retrace again, come up to near the 50% retracement level, and we continue that trend and put in a new low, retrace to the 38.2, put in a new low, retrace to the 50%, put in a new low, and look at what we've done, guys. We have not put in a new low yet. So we're actually starting a little bit of a bullish cycle here. And there's 3 stages to a reversal, okay? There is the downtrend, which we've got on this side of the chart, and then you get your box consolidation, which that's what we could be in right now. We really could just be consolidating and preparing for a potential reversal to the upside, which would be the final stage of a reversal. Remember, there's 3 stages: the downtrend, the box consolidation, and then the reversal itself. So we're going to see in that could be also a possible scenario to play out as well. All right. Now, if you take a look over here, this is our Fibonacci's, but it's actually the support levels this time because we're actually starting a little bit of an uptrend. Okay. So what this means is that we're actually going to be bullish on SWK above these 3 levels. And if we break below these 3 levels, then that's how we're potentially going to spot a reversal, because you can use these levels as well to spot reversals versus trend continuation, right? So a reversal would be a move down, retracement, consolidate, okay, and then you break through those retracement levels. That would be an upside reversal. All right, and a downside reversal would be a move up, retracement, consolidation, and then break through those retracement levels. Okay, versus move up, retrace, continue the trend. So that's why they're really useful. That's why they're really helpful. That's why I like to use them a lot. Now, notice this also lines up right along with that neckline here on our head and shoulders. So the 3 main levels that we need to stay above, okay, are going to be 87.06, 84.04, and 81.02. If we can stay above those, we could end up getting a nice little 3-wave move up here to about the 102 to 107 price levels on SWK. But if we move up and we've started to consolidate and we break through those levels, most likely we're going to see that head and shoulders pattern play out, and we're going to get a retest of the $70 to $75 range on SWK. Now, hopefully you enjoyed this video, and if you did, smash that like button, subscribe to the channel. I do videos just like this every single week. I'm covering stocks, dividend stocks. I'm doing the bond market, as well as cryptocurrencies and commodities such as natural gas and gold as well. So, just make sure to subscribe if you enjoy it. Okay. I'm going to head out. I do viewer request every single week though. So if you actually want to see your stock, whether it's a dividend stock or maybe it's a tech stock, something like that, all you got to do is comment down below with the ticker symbol, and I'll make a video on it as soon as I can.